Hey, welcome back to the dive. Today we're chatting with Otavio Costa, portfolio manager with Crescat Capital. Tavi, welcome to the dive.
Hey, thanks for having me.
So you recently tweeted that we are at the beginning of a commodity supercycle. Can you walk us through this thesis?
Sure. I think there's a lot of reasons behind this, but it's especially is regarding this decades of underinvestments that we had in the space. We've had a lack of exploration in a lot of commodities, especially precious metals and base metals, and declining capex across almost virtually all parts of the industry. And so this capital conservatism with commodities being out of favor. I mean, we had risk parity strategies where you allocate capital towards bonds and equities. I have not seen any other time in history where corporate bonds and equities were actually at record valuations at the same time. Not even in the tech bubble. Tech bubble, actually, corporate bonds were not at record lows in terms of yields. And that's even considering junk bonds too. And so there's quite a lot going on in terms of that. And we think there's sort of a great rotation happening right now where a lot of investors are switching and swapping, I would say, from record overvalue assets to start looking for something that is out of favor. And so in line with that idea, I think there's something else going on with very similar to what happened in 1919. Aside from the the uniquenesses of what happened after the World War One, we've had we're coming out of a pandemic, and given the industrial capacity was so low at the time, what we saw was that raw materials were rising because commodities are actually rising in price, and that's mostly not driven by aggregate demand. It was actually aggregate supply that was so constrained. I think we have a similar position right now happening, and then commodities are really starting to rise. So the Federal Reserve is really trapped. You have a tsunami of treasury issuances going on with stimulus from the fiscal side increasing, and at the same time, who's going to be the buyer and commodities. So we're seeing the economy running hot with commodity prices rising there. So if we want to keep funding extreme deficits, we got to be doing a lot more than what we're doing in terms of monetary stimulus. So that is a major part why commodities come in very handy as an asset that may benefit from all this. So I like commodities quite a lot. I prefer buying precious metals and a few base metals. We like oil as well. Does it mean it can get caught up during the sell-off in equity markets? Sure, it can get caught up, but it's extremely cheap, and I much rather own that than own the equity markets.
We hear a lot of talk about yield curve control, and you have a special gift of explaining complicated concepts in an easy to understand way on Twitter. Can you explain to our audience what the goal of a yield curve control is and how likely is it?
Well, first of all, I think stepping back a little bit, yield curve was actually inverting back in 2019, and that is usually what signals recessions in the past. And there are two types of recessions that really happen throughout those signals. You have usually they can coincide with the inversion, or they can actually really signal that recession might be on the horizon for the next year or so. We had that in '06 and some other times in history too. I believe the tech bubble was also signal a little earlier, the inversion and then the steepening. But it really is a lot of times a steepening of the curve that really causes the decline in equity markets and creates these issues with the economy. So it's kind of what we're seeing now is this tightening move in the long-term nominal rates. So the 10-year yields have been rising significantly because of this issuance of treasuries. So when you break down how the government's funding its own debt, mostly at the beginning was through short-term maturities. So T-bills were basically what really funded most of those issuances. And then later on, what we saw back in '08 as well and now is that they began to really transfer towards longer-term maturities. So there is a large issuance of 10-year yields and so forth, yields with higher duration. And that's having an impact that increasing supply. And when you break down as well the Federal Reserve purchases of treasuries in 2020, in average, they did about 197 billion. This year, they're doing about 80 billion. So it's 60% less. While when we also break down the stimulus part of it, we saw 2.2 trillion pass in during the CARES Act, another 900 billion in December. This year alone, we're talking about 1.9 trillion for the rescue part of the stimulus package, and the recovery is going to be another close to 3 trillion. So it's about 4.9 trillion dollars if you do the math. So that's 60% higher than what was passed in 2020. So spending is surging. The Federal Reserve is doing less than we did it in 2020 in terms of purchases. So going back to your question, yield curve steepening is a worry. Is something that we're seeing now. It's crazy to think that yields at sub 1.5% in the 10-year yields is bothering the equity markets. I mean, it really tells you how frothy things are. So in my view, it's almost imminent that we're going to see some sort of yield curve control. So that means capping the long-term rates, so it allows the government to be borrowing money at cheaper cost of capital. So that's basically what's going on. And aside from that, remember, a lot of risky assets are priced according to rates. And so it's difficult to justify something at record valuations with rates rising. So and there's a lot of reasons why it's almost like a national defense aspect of policymakers to suppress interest rates. And by suppressing interest rates, it creates an environment for tangible assets. So everything is involved here. Everything is a kind of a feedback loop, and it falls into this whole idea of buying commodities and selling equities, in my view.
Okay, so let's talk about the silver short squeeze. What key dates or metrics catch your eye in assessing the overall silver market?
Silver squeeze is an interesting move. I think it brings the awareness of what's going on in the market, but I think it's much bigger than that. I think it's much bigger than just a market squeeze. And so when you look at the fiscal imprudence, the monetary dilution we're seeing, the way policymakers have been reacting, and this need for further expansion of the monetary base to suppress rates, it creates a supercharged environment. The lack of alternatives of investments that yield more than inflation expectation. I mean, everything now, yields. I think that the current earnings yield in the S&P 500 last time I checked was about 1% higher than inflation expectation. So, how do you justify again buying something like that with that amount of risk? So it's forcing investors to look for investments or assets that not necessarily yield something, but have the potential of price appreciation. So that is why I think a lot of investors are flowing into or looking for something like gold, silver, and even Bitcoin that don't yield anything, but perhaps have that potential. Silver is cheap relative to money supply, extremely cheap. And when you saw back in 2008, late 2008, the Federal Reserve printed close to $1 trillion and really created this movement of about 400+% in silver for the next 2 to 3 years. Now, remember, today we did about $3 trillion. So it's 3 times what we did back then. And trust me, if things continue to fall apart as they are now with the equity markets, we're going to see a lot more than that. And so how much is going to be this appreciation towards silver? And another thing that is important for silver is that it is a major part of this green agenda. If we want to go from the old economy to the new economy, regardless if it is from a green agenda perspective or from an innovation perspective, the both need commodities. Commodities is your highway from the old to the new economy, and that highway has been cheap. Things are all cheap. And so I think those things are about to get a lot more expensive and will change the whole landscape of the macro environment. So I like silver quite a lot. And silver is not only cheap relative to other assets, but especially relative to gold. So, so those are sort of like kind of the macro imbalances that create this demand for precious metals. But also there's a supply side that is even more compelling. We haven't seen any new discoveries of gold and silver, new discoveries or major new gold and silver discoveries in the last 3 years. And that is in a downward trend as well. So, it goes back to this whole idea of the 1919 scenario, and also this over 10 years and decade of miners being reluctant to spend capital. So, only if people knew how much, when silver goes up in $1, $2 an ounce, how much leverage you get in a deposit of silver in the ground. It's absurd. The intrinsic value that increases because of that is really interesting for any investor. And I don't think a lot of people are really paying attention to that. So there's a lot of opportunities here. And I think silver is perhaps the cheapest macro asset I've seen.
How are you forecasting the economy, assuming life gets back to normalish at some point over the next 12 months?
That's a good question because we're just going through one of the largest wealth transfers we've seen in history. We went through, the government is running a money party, and it can't allow it to stop. It's as simple as that. We're seeing, even though a lot of people like to talk about inequality, which is certainly something that is happening today, and it has been happening for a long time. No, we're seeing a very, very large increase in wealth of the bottom 50%. It is the largest we've seen on an annual basis in history. And so, and you compare that with '08, '08, we saw a decline of about 84% of net worth in the bottom 50%. So now when you include the other parts of the society, we've had somewhere close to $12 trillion increase of wealth, in 6 months. In a period where we saw one of the worst recessions, or it was a pretty steep, you can call it a depression-like economic downturn. So even though it seemed to be quick, we're now coming back. Things are, perhaps coming back to more normal, but this is going to create inflationary forces in a huge way. When you look back also in how we're going to pay down this debt, because I think it involves back what we're going to see in the economy going forward, going back to your question, is that when you have this level of deficits, and which tends to accumulate public debt, which is certainly the case, about 130% of government debt relative to GDP, highest level we've seen in history, and deficits are close to World War II levels, worst levels since 70 years. So, when you put that together, we tend to see a very high increase in tax rates. And we're not seeing that yet. And we have the political environment, political leadership in place that we may see that. Again, this is not a political view. I'm just looking at throughout history. When that increases, somebody pays for that. And usually the taxpayer is on the hook. So I think that's going to be the case here. And that's going to be, very, very negative news for risky assets, very negative news for the S&P. Go back to 2016 when we had the Trump administration really talking about tax cuts. That did not become effective after a year or two after those talks started, after his election was successful. But the market really moved way before. The market moved in 2017, went up significantly. So do not expect those things to really become effective to have an impact in the market. Market's forward looking. So this is all going to have an impact on there. So I find it difficult to see real organic growth. Okay. So that's, go back to this dependency of monetary and fiscal stimulus to keep the economy, to keep propping up the economy. How long can we see that until, inflationary forces really begin to pick up and completely bother and limit central banks from doing that? Now, that's going to be an important question in the following months or so. But as of now, I don't think this money party can stop. So in the next year or so, I'm certainly expecting perhaps even a disconnect from the economy in a different way. We saw first, in 2020, we saw the disconnect where equity markets were rising, but the economy wasn't doing great. This time around, I think it could be quite the opposite, where the economy might improve a bit, but then the markets are already front running that move from 2020 and may actually go back to reality. So I think there's quite a lot of things to unpack, but I'm not bullish on the economy. I think I'm very, very bullish on commodities. Well, I don't think I am, and I'm positioned for that as well.
We're a small cap platform, and we've never seen things more frothy. How much longer do you think speculative tech equities can maintain this level of interest?
Very difficult because so I think it's going to be very challenging for high duration assets, and tech companies certainly fall into the category. How much can the Federal Reserve allow? Federal Reserve is running a live experiment right now with 10-year rates. And if you're a tech investor, if there is one person should be concerned with what's going on with 10-year rates, are those folks. And so I think it's going to be a very difficult environment. I mean, tech companies have done tremendously well, have been the growth stocks of the last decades or so, have really changed the whole U.S. economy, even relative to the rest of the world, with the U.S. really embracing the internet movement and all that, and really being able to create Silicon Valley as a house for a lot of those companies to really be successful in general. So it was a really incredible years that we saw for the tech companies. I think that the new growth stocks are going to be the mining companies. I think that those are going to be the ones that are going to be proving out as we have cost of capital rising. I think profitability is going to become a more and more of a big deal. We've had mining companies now in the precious metal space yielding better than tech companies in a free cash flow basis. I think that's very positive. And remember, I mean, the fact that we have one tech company, or you can call a consumer discretionary, whatever you consider Apple being, and you can put other companies in that. But Apple itself, market cap being 4 times the size of the whole precious metals industry, that doesn't make any sense. So I think it's going to be challenging years ahead for the tech companies. I was just looking at a chart that I produced today or a few days ago, looking at energy stocks relative to tech companies. We've been hearing a lot that energy stocks have been moving a lot and maybe moved too much already in the short term. But when you look at that relative to tech companies, I mean, it's the unwinding of that is just so much in the beginning, I think. And so there's a lot of opportunities in resource stocks relative to tech companies. And, I'm very bearish on tech in general.
As a portfolio manager, how do you go evaluating junior mining stocks?
So there's a lot of things to unpack there as well because of the supply cliff issue with producers in the gold and silver space. When you look at their mine life of a lot of their reserves and how they're going to be depleting those mines going forward, and the geological challenges of finding gold and finding silver, and that exploration budget decline that I was referring to, and the capex also being something that is diverging from metal prices. In other words, miners are not spending money to really as they used to. So they've had this skepticism in the industry of being capital destroyers, which has been right. But free cash flow, they're finally generating cash flow and free cash flow in general, and it's something completely different. I call it the new era for miners. They're paying down debt. They have clean balance sheets. So they are actually getting cashed up. They're in a very good environment, fundamentally speaking. So I think what that tells you is that there are different parts of the mining space. A lot of people are constructive on gold, silver, Bitcoin, but as you become constructive on those, the natural sequence of thinking here for an investor is to look for something that you can go up on the risk curve and perhaps get more leverage. So that's when you start seeing a lot of investors buying into Newmont or Barrick or Kirkland and so forth. And those are large miners that we've all heard of it. They have consistent production throughout the years. And so, in our view, I think a lot of those companies are cheap and undervalued, historically undervalued, and are probably going to be cashed up for the following years, are going to be looking for new deposits to really, extend their production lines. And in our view, there's a lot of value to be unlocked in the exploration and discovery side of that industry. And so we've been very focused in buying the best properties across the globe that have very high grade and economically viable gold and silver deposits. We've had also been positioning ourselves in other metals such as nickel or just copper in general. And so there's a lot of opportunities in different parts of the market. So we're very bullish there. And I think that, there's a very speculative, segment of the industry, which is that part. I think if you are an investor with a very long-term mentality, I think you can really tackle that whole market with a lot of mispriced opportunities. So we're very excited about it. We did a partnership with Quinton Henney, one of probably the best geologists in the exploration side of things in the world. And so, we're looking for gold. Clearly, we're clearly looking for gold and silver all over the world in strategic geographic locations. So, so very bullish there.
So overall, what other commodities are you the most bullish on?
Well, definitely have some oil. We think oil is also mispriced. I mean, production is falling apart in the U.S. domestically and some other parts of the world. We've had the amount of drill rigs is very low in activity, and when you look at that relative to history, that tends to actually coincide with some other bottoms in oil markets. Oil already bottom in negative prices, which is crazy to think, but that happened, and so a lot of those companies. I mean, back in 2014, we had a very negative stance about oil, and we had a lot of shorts in oil. And I remember looking at a lot of those companies, and fundamentally, they're losing money on a free cash flow basis almost every quarter. I'm actually not seeing a lot of that. A lot of the companies we were short back then actually look fundamentally strong today. So we're seeing a lot of interesting ideas from there. But oil is an interesting play because it might play out different than a lot of the gold and silver miners idea. Given how long are we going to be running the economy with oil? A lot more than a lot of people think for a lot longer, but perhaps not the same strategy of buying exploration companies. I think meaning buying those properties that we're doing in precious metal space. I think it's a different strategy, but there's a lot of value to be unlocked in the energy sector as well. There's nickel companies. We think that those companies also look really cheap. It's hard to find good miners in that space, but I think we have a good handle of what are some companies that can do very well. We have some copper plays in different parts of the world that have not been really, truly beaten up in terms of exploration. And so, uranium plays look interesting. I think the whole commodity spectrum looks interesting. It's just so hard to spend all your time understanding all parts of it. So, agricultural commodities, we're not doing anything there. I'm sure there are some opportunities there as well because those have been beat up for a long time. Do I have an edge on that? Not right now. I'm not a no, I haven't been following that very closely, but I think there are opportunities in that side of the market too. So, certainly very diversified, but I think we do have an edge here on with precious metals, and that's where we've been focused. I think silver, as I said, will probably surpass $50 an ounce this year still, and if that happens, it could really take off. And as I said before, the intrinsic value of a lot of gold and silver deposits, in the ground is really incredible. So I think there's a lot of buying opportunities that look very attractive in those parts of the world.
Well, thank you so much for joining us on the dive today, Tavi.
Thanks for having me. Thanks for having me.
And for our viewers at home, don't forget to like, subscribe, hit that notification bell. We'll see you next time on the dive to talk all things small caps.